Welcome along to the next video in our series on tax planning for 2014 financial year. Today we're going to be talking about prepaid expenses, and to help me explain what we're talking about is Helen. How are you this morning, Helen?
I'm good, Alan. How are you?
Very good, very good. Okay, specifically we're going to be looking at prepaying interest because that's probably one of the expenses that most people incur and most relevant to what we need to talk about today, because I'd like to talk about a specific product and just how that would work, and that is the Macquarie capital protected geared share investment. I know that sounds like a mouthful, and it probably is, but anyway, we'll talk about that because it explains a lot of the sorts of things that we can do in terms of tax planning. So we're talking about prepaying interest.
But how does it work?
Well, it works very simply. Okay, let's say, for example, that you decided that you wanted to invest $50,000. Okay, you got $50,000.
Yes.
Oh, wrong answer.
Okay, no. I don't.
Okay, so you go along and you borrow $50,000 from Macquarie. So you've got $50,000 worth of shares and a $50,000 loan. Okay. Now, obviously, a loan attracts interest. Now, in this particular case, the interest rate is 8.5%. So, over a year, how much interest would you pay on that?
$4,250.
Very good. Okay, so you're going to pay $4,250 interest on that loan for a year. Assuming that your marginal tax rate is 46.5%, okay, which is the top marginal rate, that comes to a tax saving of about $1,975, let's say. Okay, so that's your tax saving.
Okay.
So you've actually paid out $4,250 and got $1,975 back. Doesn't sound like a real good deal. But the important thing is what's happened up here in terms of your $50,000 worth of shares. Because it's a capital protected share investment, what that means is that if the shares go down, you don't lose any money. So you've still got $50,000 worth of shares. Okay, you'll get your $50,000. They're not going to ask you to chip in for the $5,000, say that the shares go down. Okay, but if they go up to 60, you get to keep the 10. So that's pretty good. So, so you stand to gain in terms of the asset value, and the taxman is helping you with the interest. Now, the really exciting thing, I'm assuming that you also don't have $4,250. So you can also borrow that. Okay, so you can borrow that. So in actual fact, you haven't paid any money at all. You've got $50,000 shares, you've got your interest paid for $4,250. The taxman is just giving you back $1,975, but obviously you're a little bit short in terms of that. That's the nice thing about shares. The taxman pays, sorry, not the taxman, the companies that the shares are in pay dividends. So you've got dividends as well, which are partly tax paid, up to 30 cents. So you've got some extra cash flow to help you pay the shortfall on the interest. Okay, so largely it's going to be self-funding. So it's pretty neat. And the fact that you don't stand to lose money, but you've got the opportunity to gain money, makes that whole process pretty good.
Sounds good, but what sort of shares can I buy?
Well, that's the thing. Because Macquarie basically are giving you this sort of capital guarantee, they're not going to let you deal with speculative mining shares or whatever when you're likely to lose money. So what they're really going to be looking at is your blue chip shares, your banks, your big mining companies, your big retailers, those sorts of guys that aren't really likely to lose money. So although they're giving you this capital protection, they're not willing to take all risks. So I mean that makes sense, and they're obviously the ones that are going to pay the most dividends too. So, and that's what you want. You want some dividends coming in to help you with the interest payments. So it works really well. So, yeah.
So what is the normal share investment?
Well, you need to talk to a financial planner about that, okay? Because, I mean, obviously I can't provide you with specific advice in terms of investments in this sort of environment. What I would suggest is that we get a financial planner to talk to us and make some specific recommendations, and also look at whether it's going to work for you.
Okay,
Right?
yeah.
Because obviously if your income tax rate is not at 46.5, then the whole thing is not quite as valuable. So we just need to see whether or not it's going to work for a particular person. So it's not one of these one size fits all.
Yeah.
What we're really saying is the opportunity exists to prepay expenses, create some tax deductions. Interest is a pretty good way to do that. And I mean, and prepaying interest will work for rental properties, other sorts of geared investments. So it's not just this product that it works for. So what I would suggest is that if anyone is really interested, come along and have a talk to us, and we can decide whether or not, or which way we need to proceed. So thanks very much for helping me explain that, Helen. There's a few other little twists and turns in there, but if you're at all interested, come and have a talk to us, and we can see whether or not it's going to work for you, and specifically how we can make it work for you. Thanks very much for watching. Next week, another topic. See you then.
Right.